The S&P 500 and Nasdaq have entered correction territory, causing concern for many individuals who have invested in mutual funds that use these indices as benchmarks. The S&P 500 ended last week down over 10% from its recent high in July, while the Nasdaq Composite Index closed at a similar level. While this may be worrying for those with 401 accounts, experts advise that market dips are often temporary. A correction occurs when a market experiences a drop of at least 10% from its peak, indicating investor skepticism about future stock performance. It is more severe than a pullback but not as severe as a bear market, which involves a drop of 20% or more. The recent stock market decline can be attributed to rising treasury yields, which make bonds more attractive to investors. Additionally, concerns about the Middle East and other economic factors have contributed to the decline. However, it's important to note that the S&P 500 had a strong performance in the first 7 months of the year, so some pullback was expected. For individuals with 401 accounts, it's crucial to remember that the market tends to recover quickly. Pullbacks typically take about a month and a half to return to break-even, corrections take around 4 months, and bear markets can take up to 13 months. It's important to have a long-term perspective when investing in stocks. If investors feel compelled to take action during a market downturn, experts suggest considering portfolio rebalancing, purchasing high-quality stocks that have fallen in price, or engaging in tax loss harvesting. However, the best advice is often to resist making emotional decisions and to avoid letting emotions dictate investment choices. In conclusion, while the recent correction in the stock market may cause concern for 401 holders, it's important to remember that market dips are normal and often short-lived. By maintaining a long-term perspective and avoiding emotional decision-making, investors can navigate these fluctuations and potentially benefit from market recoveries.